Hi, this is Randy Finney with Right Side of the Chart, and this is a market recap for Tuesday, August 2nd, 2016. We had some interesting developments in the market today. Nothing huge. We were down in the S&P 500, down 0.64%. A decent down day compared to what we've seen recently, but nothing really compared to some of the other big days over the last, throughout this year and certainly historically by standards. Not a huge down day, but then again, technically significant, especially with what we've seen recently. Because if you take a look here, we've had an unusually tight sideways trading range now for almost 3 weeks. And what we did, we closed today, the S&P closed at 2157. So if I put a horizontal line there where we close at the bottom of that body on that candlestick, you look to the left and it goes all the way to that green candle, and that is, I'll measure it out here. If you look at the pop-up box in the left-hand side of the screen, just towards the bottom, you'll see some red numbers which show the percentage and point gain and loss at least the area I'm measuring over. Just above that, it says 18 days and 12 bars. So that means 18 calendar days. That includes weekends or 12 trading sessions. That's what we've wiped out today. So in other words, today's loss in the market, although we didn't put a bearish engulfing candlestick because we didn't come above this, today's candlestick didn't engulf this, it's almost the same net effect. What we did do is wipe out nearly 3 weeks of gains in the market. So that does something psychologically. It just means all those people that bought in the last 3 weeks were wiped out. Their gains were wiped out today, and they are now underwater. So that's how technical analysis works. So bearish certainly, but there's still some other support levels and sell signals we need to see to really get a little bit of a stronger sell signal, if you will. But we did have some sell signals trigger today. Now the divergent high that I talked about for the last few days, that was actually confirmed a few days ago. I mentioned that the negative divergence with this bearish crossover on the MACD, and of course the MACD is only moving lower today now, clearly pointing down, and so we have that divergence in place on the S&P 500 as well as some of the other major indices right now, which paints a longer-term bearish picture. Lately, I've been focused in the 60-minute charts. I'm going to get into those in a second because that's what has given us, helped us with the timing here. These divergences have been building, and I talk about that all the time. Divergences are not a sell signal. They are just a warning of a likely impending trend change. And it's, on the daily chart, you can use those divergences to try to help gauge how deep or how long that trend change may last. But it's at least for me, it's the 60-minute charts and the intraday charts that help hone down the entries and exits on those trades. And today we did have some sell signals, and I put up the IWM as an official short trade. I may or may not add the SPY or the Qs. We'll see, but I'll certainly be adding some other trade ideas here in the very near future. Let's take a look at a couple other indices here. The NASDAQ 100, what did it do today? We were down 0.77%. Pretty bearish candlestick there. And, what has that done? That's also taken us back down below the 2015 highs. So there's a technically significant event. We had just taken out, peeked through, taken out the highs, and so far that is a bull trap, or at least a failed breakout. I won't even call it a bull trap because there was no conviction on that move. Any bull that took that to be a breakout, I'm not trying to offend anybody here, but I mean, in trading, you want to see breakouts. A couple things in my book. And I've said this before it even happened, and I said this on the S&P. I don't take breakouts on extended moves when you have a breakout level, whether you're trading a pattern, let's say a wedge pattern, or a breakout above resistance. I don't take breakouts that are overbought or overextended just to get to the point of the breakout. At best, what I want to see, or at least I should say, what I want to see, if we had a run up to that level, I want to see prices work off, pull back, or at least trade sideways to build up the energy for a sustained and lasting breakout. So breakouts that do this, in the broad market, in NASDAQ 100, a 14% rip just to get up to the highs, to think that breakout would just continue on with another 12, 14, 20, 30% gain. Possible, anything's possible in the market, but very rare. So that's what's happened. And so the fact that this breakout failed is no surprise. The Dow also failed its breakout to new highs. This is the Dow Jones TJIA, the Dow 30. You can see the high back here from 2015. So that breakout has failed now. And the only one that has, I know this was the first one, is the one that made a lot of headlines, the S&P 500. Put this horizontal line there. So there's still a little work to be done before and if the S&P fails that high. But so far that's what's happened today. Quite a few broad diversified indices that have broken out to new highs failed those highs today. And a couple other things to note before I get off the daily time frame. The NDX, as I just mentioned, was up or down 0.77%. So not a horrible day, but the NDXE equal weighted index down 1.16. I've been talking about quite a bit recently how I'm seeing a pretty pronounced deterioration in breadth, especially in the NASDAQ, which is typically the leading index, the NASDAQ 100, with a lot of biotech and tech stocks. You can see the NDX, the equal weighted, fell well shy of making new highs so far and has reversed, and was also down quite a bit more. And I've pointed this out quite a bit on the site lately, especially in the trading room, that divergence. You look at the components. Here's a watch list I have of the Qs. Most of you have probably seen me use this before. It's my real-time breadth indicator. I can get the advance and declines on any sector, any ETF. So here what I did, I have a watch list of the NASDAQ 100. As you can see on the bottom, there's 105 stocks within the NASDAQ 100. And I've sorted these by gainers and losers. A couple things I'll point out. First of all, the NASDAQ would have been down a lot worse, and that was evidenced by the NDXE being down more than the NDX, the equal weighted index being down more, if Biogen didn't have such a big day today. Biogen was up, 9.37%, and that's one of the top, I believe that's in the top 20, if I'm not mistaken, components as far as weighting goes in the NASDAQ 100. That's a $63.5 billion stock. And there were a couple other names up, you can see Discovery, a couple other stocks that were up. But what I'm trying to point out here, if I click on the last of the green stocks today, that shows us right down here. You go to the bottom, 11. This is 11 stocks out of the 105 stocks in the NASDAQ 100 were positive today, or at least in the QQQ, the tracking ETF. That means you had 10 declining issues to every one advancing issue. Now, keep in mind, we weren't down 3% on the NASDAQ 100 today. We were only down, as I just mentioned, was not even 0.8%. So this is awful breadth, and it shows you that fewer and fewer stocks were carrying the index, and this today, in this case, held it up. In other words, it would have been a lot uglier. So there's a lot of ugly things going on under the hood. Let's just zoom down to the 60-minute charts, and we'll take a look at what I'm watching for here. QQQ 60-minute. All right, the Qs is as far as all the broad market indexes out there or indices, it looks as good as any of them out there right now. I think it's going down. The charts clearly point to me that it's going to drop. We have a divergent high here. This was a ascending price channel. I've covered this many times, but we haven't broke down. I put an orange line here at 114.12. There's a gap there. There's horizontal support. And so we just came down and bounced above that level. In fact, we broke down below the ascending price channel and closed right about on it today. If you really zoom in and look at those candlesticks, you can see we're pretty much closed right on it, depending. You could drag it like that. There you go. So we're right on that channel. Divergence is confirmed, negative divergence. However, we don't have the trend indicators triggering sell signals yet on the 60-minute time frame, nor do we have that break of support. However, everything else, all the other indices have already confirmed as of today. My trend indicators have flipped to bearish. They're pretty accurate. Nothing's perfect. The 1333 trend indicator went bearish today. You can see it closed red. The MACD signal line, the 9 EMA, has now crossed below the 0 line. That does a good job of defining bull trends when above, like it was here, bearish trends when below, like it was from here to pretty much over here. And so there's two trend indicators of flip bearish. We did break that. We broke down this from this support line, this slight uptrend line right here, and pretty much closed almost on a back test of it from below. I'd like to see this 215.30 level go, and I expect that to happen, but we did manage to close just a hair above it. So we're still waiting for a little more downside, and price is most important. When trading off the charts, the trend indicators and everything else comes second. Price is first. And here's the small caps IWM 60-minute chart. We had this pretty clear pattern, this sort of a wedge type pattern. Very impulsive breakdown, as you can see there, and came down. This is a pretty significant support zone. It's defined by this gap back here. That gap is from July 12th. So the July 12th gap. You also have this reaction high. And our next support level, that's where I set the on the trade. The first target is set at the bottom of that gap, because I expect a gap, at the very least a gap fill, and I also think we'll come down and backfill this gap as well. That's why I set the targets down at the bottom of the gaps. Very often, I'll set targets at the top of a gap. See, we have a gap right here and a gap back here, as well as a reaction high. But I do favor, again, at the very least, a move down to that top of that, the bottom of that gap, which is at 116.98 roughly, call it 117. So I set the target just above. And as I mentioned today in that trade, when I posted that, it will more than likely be extended if we see some follow through. And the follow through I'm looking for, again, are those support levels I just went over on the SPY and the Q, as well as this gap here. I want to see this taken out, this first target level or the bottom of that gap taken out. That'll take out that previous reaction high on the small caps. And there you go. Trend indicators are bearish. And remember, if these 60-minute charts start playing out the way I think they might, I need to fix this, then that would have larger repercussions on the daily chart. We have, for example, the IWM. I talked about the other indices failing those breakouts to new highs. The IWM, although still well off its highs back here from 2015, had this major resistance zone I pointed out, and you can see it goes back a lot of reactions in this yellow resistance zone, and we tried to punch above it and so far have failed, and we're moving down pretty impulsively. You can see that pretty bearish candlestick here on the daily chart, which also wiped out about nearly 3 weeks of trades here on the small caps. There's also this trend line, the divergence in place, extended consecutive divergence, everything that I see right now, unless the bulls can turn around here, the buyers can step in, turn this out, ramp this up, take out the recent highs on, more importantly, obviously you want to see it on the small caps, but more importantly on the S&P 500 and the NASDAQ 100. So that will help the bullish case, as will, and just to really try to cover all my bases here, for those of you who are bullish, and I know there are, quite a few that expect the markets to go to new highs, let's find another board. Okay, see this blue downtrend line? This was a downtrend line that was taken out right before the previous reaction highs were, and you can see that's really where that was a breakout right there, and the market moved up sharply. So I'll say this: I expect the S&P to fail that breakout to above the 2015 highs, especially as extended as it was. So the bullish scenario, if I were longer term bullish and looking to position on a pullback, which at this time I'm not for the reasons I mentioned, but if I were, I would look for a move down to this level. I would almost expect a failure of those new highs. I don't think that's as technically significant as some breakouts to new highs are, for various reasons. But that's what I'd be looking for, a breakout position here. You can put your stop somewhat below there, that downtrend line. Plus, from my experience, a lot of these breakouts to new highs often come back and they don't backtest the high. They come in a little bit below. I don't know whether it's just to clear the stops. I imagine there's some of that in there where the big boys run the stops for people that want to come in and buy right there, or the shorts that want to short if that previous high is taken out. In other words, shorts might say, "Oh, that's a bull trap." The second we move under it, this is where the bullish case will really start to rapidly diminish if we come in and we move back below the back test of that downtrend line. And look at it on the Dow as well. You can see the Dow has a similar downtrend. And there it is off the 2015 highs, pretty well defined. And again, you can see, so the Dow has failed its new highs, as I mentioned, the 2015 highs, although this trend line has a lot more reactions. I guess that's what I'm trying to say. You have that peak right there in 2015. You have reactions there. There was an intraday peak, but we closed back below it. So numerous candlestick tags, plus the impulsive action. When we broke out there, you can see the impulsive buying that took place. More impulsive than what we've seen since the 2015 highs were taken out. So again, bullish case. That's what you want to see. I would wait if I were bullish, ideally, for a pullback to this level, go long, and with a stop somewhat below. That's not my take. That's not how I'm positioning. So, but if you do want some numbers, I could probably give you something right here. That's not the line I wanted. You know what? Yeah, I'd have to study the chart a little more, and I'd also have to wait to see when we got there. What I mean by that is it's I drew a line, just a straight arrow down, and I do think the move down will be pretty swift to get there. So I don't know, maybe 17,700, somewhere in there possibly is a stop. I can see some support there, but again, we'll get into that later. And if I get questions put to me in the trading room, for those looking to position long, I'll certainly share my thoughts on that, where to put some stops or where to average in if you want to go into different levels. Let's say we do fail that level here. We have some really big support down here. All right. Let's see. Yeah, I think we'll talk on gold real quick. I've had a couple inquiries about that lately, so I'll share my thoughts here. I'm thinking gold is most likely due for a considerable pullback, especially in the mining stocks. And the problem with a short on gold, and I've been waiting for the right entry to put up an official short trade, particularly on Nugget. I want to short the miners on the next pullback. And even if we see, which I think is very likely in the miners at best, weeks, if not months, of sideways consolidation, I think the miners have really come up to a pretty significant resistance level. However, you have to confirm a trade in the miners with gold. And, I could make a pretty decent case right now or very soon to start shorting the miners. I need to see some evidence in gold. So what I think will happen here, you can see the divergent high drawn out here. It's a little clear here. See this line here over here. You have this negative divergence, clear negative divergence on the RSI and the MACD. However, you have a bullish crossover on the MACD. You also have the RSI defending the 50 level. The 50 level, when tested from above and below, often acts as support. So we have the RSI successfully bouncing off 50. We have a MACD making a bullish crossover. So at this point, I would hold off. I certainly have no desire to go long at this point, but be a little cautious on the short side. What I think might happen, let me try to draw it out here. Another push up here on the MACD. See the MACD turn back down. Have prices come up a little higher here, make a new high, and then what that would do is, let's see, what that would do is give us another divergent high here. Divergence confirmed down here. I mean, it might even be the same trend line here that I have drawn. And at that point, see then a reversal come. Targets would be this 125.10. I haven't really marked this chart up for targets here. We have this yellow uptrend line that would come into play. This 125.10 area might come into play. But let's take a look at the mining stocks as well real quick. The mining stocks have put in a new high, a marginal new high. We have this potential doji reversal, stick. Let's see what happens. You need to see bearish follow through, but the miners just put in a new high. I sort of have that drawn out here. I have the MACD also making that bullish crossover, but it could turn down soon. So if the MACD, let's say the miners and gold push up for just a few more days, We might get a little bit more, another high here, a new high, a couple new highs here on GDX. Let's say something like this. Once again, it'll probably be that trend line extended where we fail, turn back down. That would put a lower high in the MACD, lower high in the RSI, confirming the negative divergence at this point, because right now we don't have negative divergence. We only have potential divergence on GDX, and that would pave the way for a nice reversal. I mean, the very least, again, these aren't targets. These are lines that I had on this chart. I didn't really update for this video, but what I'm looking at and paying a lot of attention to is this weekly chart. And I've covered this quite a bit in videos and static posts over the last few weeks. You can reference those. GDX, there's a big fat gap back here. It's hard to see with all the lines on this chart. Maybe I'll find a cleaner point there. You can see that gap right there, the horizontal resistance right there, numerous reactions back here in 2013. And that's where we're at now. Extremely overbought. We do have divergence. If you note here on the RSI, you have that divergent high. RSI making a lower high. PPO still pushing up, although both of these indicators are extremely overbought. And as I've mentioned, we have a lot of the leading mining stocks. Well, look at these, and, some of the big names in there, like Barrick Gold and some others. I have to put it back on a weekly chart. Depending what board I have, you see Barrick, Newmont. A lot of these names are at or very near these key resistance and Fibonacci retracement levels. There's GG, FNV. So you go down the line, there you go. Some of these have overshot by a little bit. Is it possible that GDX wants to push higher? Yeah, we're at that resistance level, and resistance is resistance until broken. Maybe it is. Maybe it's taken out. I don't see a whole lot of resistance on this weekly chart, this long-term chart, until this, what is that, about $39 level, and that's another 25% higher. So I'm sure some are calling for maybe a blow-off top in the miners. Possible, but, this move has been, well, I wouldn't say parabolic. It's been extremely, steep. Blow-off top would have to be almost straight up at this point. Anything can happen, but that's what I wanted to point out, is that the miners they're very overbought at resistance, and you have that divergence in place when you go down to the daily time frame. Both on gold, you already have current divergence in place on GLD and gold, and you have potential divergence on the miners. So maybe be looking at a short on Nugget. And with Nugget, what's nice about that, if you want to just do a quick pullback trade, you can short Nugget. You use a little less capital because it has a 3-time leverage. But if you decide to stay in that trade for weeks or even months, because the miners are either moving sideways or moving lower, then you also have that decay working for you. So that's why I like to, when trading the miners, like do short dust or Nugget for long or short exposure to the miners, especially for swing trades lasting more than just a few days. All right, this has been Randy Finney with the right side of the chart, and in the I'll probably do an update later tonight or probably tomorrow on oil, either in static format or in a video if there's enough to cover there. But we'll see what happens. Again, watch those 60-minute levels on the broad markets tomorrow. Gold, I'm going to hold off a couple days, maybe a day or two here before deciding to add gold or GDX or Nugget or anything like that as official trade ideas. But the levels are there if you guys want to look at them. They're all in these charts. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.